Oh yeah, today's Tuesday, September 13th, and I wanted to talk a little bit about stock market corrections, um, stock market bear markets, because September or October have marked some of the biggest pullbacks in the stock market. Um, of course, many of you have probably heard of the crash of 1929, but what I'd like to talk to is some of the stock market pullbacks in more recent history. Maybe we'll go back first to 1987, where we saw a one-day drop of about 22% in October. That was quite a day. That year, actually, the pullback began in August, and the market dropped from about 2,700 down to about 2,200 by mid-October, and I think it was October 19th that the market dropped about 22% in one day. And if you put that in today's numbers on the Dow, that would be about 4,000 points, which would drop the market from about 18,000 down to a little north of 14,000. So yeah, that would be painful. But it's good to reflect upon bear markets and serious market corrections, just so you can kind of know, the impact it could have on your investments in your portfolio. But that was probably, the most dramatic market correction in terms of it was basically 3 months and then 22% in one day. Obviously, we have 2007 through 2009, where there was the whole financial mess due to all the bad mortgages and plenty of mistakes to go around. The rating of the mortgages, the government policy, Fed policy. But anyhow, 2008, the S&P dropped 38%, and it actually began its drop in October 2007 and didn't finally reach the bottom until March of 2009. So that was about an 18-month or so bear market. That was pretty brutal. Seemed like it was never going to come to an end. And in a way, I think the 3-month 35% correction we had back in 87 was a lot easier to tolerate because it was so short. In terms of, calendar, it was only 3 months. And let's see, what other years do we have? 2011 is one that's overlooked. August started off terribly in 2011. We had some huge down days, about 4%, maybe even 5% down. We'd have one day down like that, then we'd have, the next day up 3 or 4%. But over the course of, a month, give or take a little, the S&P dropped 19%. A lot of people don't realize that. Actually, I think it was even more. No, it was in August, it was about 19%. And then the market recovered, and then we had another sell-off, which went into early October. So from late July till early October in 2011, the S&P actually dropped 22%. A lot of people don't realize that because it didn't seem so bad after that 2007 through 2009 pullback of about 55% on the Dow Jones and the S&P. 2007 to 2009. That was the biggest one, probably most of our lifetimes. Let's hope it is, anyways. Traditionally, the bear markets, the majority of the bear markets tend to happen in that August, September, October timeframe, but they usually bottom in October or November and then come back. There are exceptions. 2012 had the fiscal cliff concerns, so the market actually that year finally made the bottom, I think, on December 31st when they not surprisingly came up with a solution at the last minute, they being the government, to the fiscal situation. But anyhow, as I was saying, typically the worst corrections are in the fall, so I thought that, being the beginning, first half of September, would it'd be a timely subject. So with all those market corrections, it's nerve-wracking, but keep in mind that for the most part, they're actually buying opportunities, and that's one reason I, prefer for most of my clients, and very easy, no-brainer type of way to have success with the stock market is to go into balanced funds. There's plenty of real good balanced funds out there. Oakmark Equity and Income comes to mind, Janus Balanced, Vanguard Wellington, T. Rowe Price, Capital Appreciation have all got really good long-term records. And the beauty of the balanced funds is that they kind of have a predetermined target as to how much they want in stocks, how much they want in bonds. It's usually about 65% stock, 35% bond. So when you have those stock market pullbacks or bear markets, corrections, the managers will go in and adjust the portfolios on a regular basis to try and maintain that 65% stock allocation, so that they're forced to buy low. And then as the market rallies back, they trim the positions and they're actually forced to sell high, which is a very effective way to have success in the stock market. So anyhow, that was it. I don't want to go on too long here. And be sure to, subscribe. That'd be great. And if you have any questions or comments, don't hesitate. Until next time. Okay, thanks.